Welcome, I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you some insights about the markets, investing, and planning. So here we are. Today is January 2nd, 2025. We're in the new year, and Happy New Year, everybody. So the last couple weeks of the year were a little interesting after the Fed lowered rates, but also was a little more cautious with their comments. It looks like the markets kind of have, over the last couple of weeks, didn't have that Santa Claus rally, but here we are. We did have, over the last 2 years, over 20% gains in the S&P. The S&P this year ended up at about a little over 23%. But the Russell 2000, which is more the small cap stocks, only ended up about 10% year to date, which is kind of interesting because it fluctuated a little bit towards this last quarter. And then the Dow Jones ended up about 12.88%, and the Nasdaq, which is no surprise, was up 28.64%. So a lot of, we ended up on a positive note, which is great. But here we are now in the new year and looking forward.
Of course, that's also why the S&P did so well, because those large cap technology stocks, which represent a huge portion of the S&P 500 index, was up a lot. So it makes sense that the S&P was up a lot, the Nasdaq was up a lot, but everything else wasn't. Yeah, they were up, but not to that extent.
Well, as Catherine said, the Santa Claus rally kind of fizzled the last 5 days of the year.
More like a Grinch rally.
And what happened?
I don't know what happened, but it had one big heavy rally day, and then all of a sudden it went straight into the can, as they say. Last 5 trading sessions, Dow is down almost 1%, Nas down 2.3%, S&P down 1.6%, and the Russell 2000 was down only 0.3%. So that actually declined less than the major indices, which it didn't rally as much as the other major indices. So that could have been one of the reasons. Typically, first day of trading, the new year is a big day as money flows into 401ks, but today is not that day. It started out strong, rally fizzled when the 10-year Treasury all of a sudden spiked, and the market decided to take another breather.
I also wonder if people are back from holiday yet.
It's a little light right now.
Yeah, it's going to be light volume today for sure. And if you judge it by traffic coming into work, it was empty.
Nobody was there. But here are a couple things. What to watch. First 100 days of the new Trump administration, what type of pro-business initiatives can be passed. Number 2, keep an eye on biotech stocks. I've said before, if we get a more business-friendly Federal Trade Commission, you may start to see more M&A activity in that space, and that's really going to help the Russell 2000 as well.
That's merger and
acquisitions, because big pharma, the big pharma companies of the world need to really increase their pipeline, and the best way to do it is to buy rather than develop. And so
the biotechs have done very little in the last couple of years.
Very little, yeah, and that's partly because when interest rates start to go up, biotechs have a tough time raising money, and so they don't go to the capital markets either. So anyway, that's something to watch. We've talked a lot about AI investing. I think it's going to continue to be robust, but you may see a shift. And I think you're going to see a shift into processors, software, and energy that needs to run the big database centers. So that's kind of like where I think monies may flow. Again, if the Fed continues to cut rates, the housing sector may improve, and at the same time, it may help the retail sector as the consumer feels a little more, willing to spend money as credit card rates decline.
Going back to the real estate, the rates for those loans are based off the 10-year, the 10-year government bond. And that has actually gone up, not down.
Yeah, it went up today, and that's what kind of killed the Santa Claus, the end of the Santa Claus rally.
I think Santa's back in the North Pole.
I don't know where Santa is. Steve talked about this before, about the S&P, where it's currently trading between 23 and 25 times future earnings. Normally, it should be about 17 to 18 times. So there's still a little excess in that S&P. So keep an eye on that as we continue to go through. Finally, I should say I was watching, and I think it was either Wall Street Journal or the Fox News did a survey of individuals about the top 5 New Year's resolutions. Number 1, save more money.
It's not weight loss.
It's number 2, eat healthy.
Okay.
Number 3, exercise more. Number
Seems to be
4,
a theme.
spend more time with family. Number 5, travel more. Now, I don't know if that's travel with family or without family, so that's up to you. And my final prediction today is this. The Buffalo Bills will win the Super Bowl.
Spoken like a true Buffalonian. Aren't you from Buffalo originally?
Born and raised.
There might be another team up north there that
here's
has
the
a
Minnesota
different
guy.
Oh, sure, don't you know? Don't overlook the Vikes.
So I was looking at some interest rates this morning to see where we're at, and the 1-year CDs and Treasuries, 1-year CDs is 4.1%, and the 1-year Treasuries are at 4.26. And then, like you mentioned, with the 10-year, a little bit higher, and even even the AAA corporate bonds are yielding kind of 4.9, almost 5%. So we are definitely seeing that shift back because it's interesting. For a long time, it was an inverted yield curve, and the shorter end or the short-term bonds were pretty attractive. But now it looks like that's definitely, we've been seeing it happen, but it's definitely starting to be a little more apparent.
Well, we've had that inverted yield curve for at least 2 years. We've had everybody and their brother talking about a recession.
Yep.
It hasn't happened yet. Maybe it will. But there's a good reason, I guess, not to look at headlines and all that. All the talking heads were saying, absolutely, we're going to have a recession, and it hasn't happened.
Yeah, when you get leading economic indicators, or the LEI, when it's been as negative as long as it has, we've always had a recession. And in addition to the negative or the inverted yield curve, I mean, that's why I think people have been talking about a recession for 2 years, because historically, what's been going on has always caused a recession over the last 50 or 60 years. So how we're coming out of this is going to be very interesting. We've had 2 extremely good years, with the S&P being up 25, 26%.
But you're talking about the stock market versus the economy.
Right. But if the stock market's doing as well as it has, the economy has been doing very well. How it's stayed this strong, I think, has been a lot of government stimulation. It's causing the inflation, all the money that's been pumped into the economy over the last 3-4 years since COVID is really not stopping. And I just read something or saw it on the news the other night. The IRS is going to give out another, I forgot how many COVID checks to people who did not request it on their tax returns in 21 and 22. They're going to give out millions and millions of dollars to people that didn't even ask for it.
Well, in the words of Oprah Winfrey, a check for you, a check for you, a check for you.
That's
the way the government's doing it.
Yeah, and have they not looked at the debt that that we're building up, $37 trillion?
Yeah, but on the other side, and we've talked about this before, is people are borrowing more money than they have been. Their credit card usage is up a lot. And matter of fact, I heard, I think the amount was like 36% of people went into debt, credit card debt, to pay for Christmas gifts this year. Wow. And that's a lot. So, yes, the economy has done well, and we might have a recession at some point. I mean, you do have them periodically. And truthfully, I don't think there's anything to worry about with the recession. It is a normal part of capitalism.
Right.
Things reset. And if the recession affects the stock market, which it could, the market could go down. We've talked about that. Maybe a 10 to 15% correction would not be out of the cards this year. If you have cash during that time frame, you want to buy, okay? Or depending on your circumstances, but that's the time you want to buy, when things are low. Yeah. And we have this discussion with so many clients that when things get bad, they want to sell, and when things are great, they want to buy. We need to reverse that process. When things are really bad, that's when you want to buy. It's just like a house. If the house that you want was $1 million and now it's $700,000 because the economy went bad, wouldn't that be the time to buy it? Not when it's $2 million. So the same thing applies to almost any asset that you can think of: crypto, baseball cards, art, stocks, bonds.
Well, it's interesting. I think now with the housing or Zillow, all those different online sources where you can see the home value of your property, it does, even though people know their values are changing, if it comes down a little bit, I don't think they're selling. I don't think there's, whereas if you have a stock or a position and you actually see it go down, then there's that panic mode.
It's very
just
apparent
it's
when you can look at
different.
your statement or look at the screen and see that things are going down. So,
Right. I wonder if I don't think your own home is a good example, only because you have nowhere to go.
Yeah.
Okay.
And it's
But
such a big process to try and move. It's like, I'm not just going to get up and
Right.
move. My
But
whole
if you
life.
had other real estate, and on the front of the garage, in the front of the house, it had a ticker that said, "This is what it's worth at this second." Would you be selling when it goes down? But you don't see it. You don't really. You know it's down, but you don't know by how much in a bad real estate market. But that's the difference between what we do when there's a million people telling you buy, sell, it's bad, it's good, it's
Right.
whatever. I think the best thing to do is try not to listen to most of the talking heads.
Right.
Because for every negative report, I'll give you a positive report. All right. And vice versa. Instead, just make sure you buy quality things. Companies, if you're buying stocks, companies that are solid, they have good balance sheets, or they're about to, have great balance sheets because whatever they're doing is now in vogue. But try to stay away from the gambling aspect of the stock market where you're betting on stocks that have no earnings, potentially won't have earnings for years, et cetera.
Yeah, that's true. And then, given the strong gains we've seen, it is likely in January that we have some sort of a pullback. People, were putting off realizing all these gains. They might want to take some money off the table, which is not necessarily good for the market temporarily. But like you say, Steve, if you've got cash on the sidelines and maybe they're raising some cash, to wait for a better time to buy something different. If they're overexposed to crypto or the Mag 7 or whatever else it might be.
Mag 7, that sounds like a
He was
basketball
looking, he
team.
was looking at me when he said that.
I was.
The Magnificent Seven.
Magnificent Seven.
And, they've done pretty well. And there's no saying that they won't do well this year.
Right.
The chip stocks are still, the AI chips are still unbelievably in demand, and there's not enough supply.
But when that part of your portfolio, doubles, triples, or more, it's time to rebalance. Take some money off the table, redistribute it, rebalance. Maybe, Catherine said rates are going up. Maybe it's time to buy a little bit more in fixed income for a while.
Yeah.
Because you get paid for it.
Well, I do remember many years ago, somebody used to always say you buy the dogs of the Dow in the new year. I don't know if that's still something that people do.
I remember the dogs of the Dow back in
I
the
heard
day.
one.
I personally don't, but I just remember, that tells you how old I am and how long I've been in this business. But there used to be a time when people say you buy the dogs of the Dow.
And why don't you explain what that is?
Well, those are the stocks in the Dow Jones that did very poorly compared to the others.
So out of those 30 stocks, you're picking the ones, usually it's the 5 worst.
Something like that.
Well, there was a 10 and a 5 stock version, I think.
Right. So you pick either the 5 or 10 worst out of the 30 at the beginning of the year, and you hold on to those for the year.
And thinking they're gonna rebound because money will flow into those dogs. But
Right.
I always think that stock is down for a reason, and I would rather buy stocks that have more upside momentum and earnings and better products than the dogs of the Dow. So I think a little differently.
You want the healthy ones,
I
running
want
strong.
healthy.
Running
I
strong.
want good. I want good dogs, not
There you
bad
go.
dogs.
Not looking for the rehab.
So
You want
as-
the Tigers.
So as we're here now in the beginning of the year, from a financial planning perspective, it's a good idea to think of some of your financial goals for the year. And I just have a couple topics to bring up.
So let me ask you a question. Is just, I want to be rich. Is that a goal?
That could be your goal, Steve.
Okay.
Goal for 2025. One is getting organized. So this is a good time to go back and reflect on your spending, expenses. Sometimes people look at that around tax time, but the reality is you should really reflect now and budget for next year, or look at your lifestyle and see, okay, what changes or updates do I need to make? And then also what we find is sometimes as we meet with clients or prospective clients, mostly prospective clients, is there's stuff everywhere. And so sometimes being organized and instead of having 10 different bank accounts with different CDs and 10 different accounts at 10 different places, having
Old 401ks.
and you'd forget about. So just being organized and just really thinking of having everything consolidated.
We could help people with that if they want.
Yes, absolutely. That's something we could do. Building an emergency fund. So if you are still working, it's 3 to 6 months. So if you have kind of a pretty standard job, it's usually 3 months of reserves, or 6 months if you're in a position where it's sales or something that fluctuates. And then if you're retired, you obviously have your income stream that you need, but you should definitely have 3 to 6 months of emergency funds built up. And then also at this time, we just talked about some debt. So probably none of our clients have a lot of debt right now, but if you do, just make sure you get all that paid off. Most client people that we work with, they usually don't carry large debt, but definitely something to consider and look at. And then now that we're at the beginning of the year, look at your investment contributions. So if you're still working, we have 401ks or simples, or if you aren't contributing to a retirement plan and you have access and you want to contribute to a Roth or an IRA, which is an individual retirement account, you can make those contributions. And the limits did change. We mentioned it in the past, but for 2025, for if you're in a 401k, the increase went from $23,000 to $23,500, with the catch-up at $7,500. And then once again, if your age is 60, 61, 62, or 63, the catch-up is, instead of $7,500, is $11,250.
Brand new category.
I know, so it's a lot. That's a lot of extra money.
And what would you like to explain what catch-up means?
Yes. So basically, you have, if you're contributing to a 401k plan and you're having money coming out of your paychecks as a salary deferral, then in addition to the regular contribution amount of $23,500, a catch-up is if you're over the age 50, then you can do the extra amount. So you want to make sure you allocate that from your paychecks as well.
So if you're over a certain age, you're still working, you can put in more money
Correct.
into an IRA.
Yep.
What if you turn 60 later this year?
So you can do the 60 this year.
As long as you turn
Yeah,
60
the
this
you turn
calendar
60,
year.
Yep. And then for
What if we
IRAs,
turn 73 this year?
then you need to take your potentially RMD, your requirement of distributions.
Then I should be retired.
There you go.
Now they keep doing this. Is the government worried about no Social Security for people in the? I mean, that's a topic for another discussion.
I was like, that's a whole
Think about that.
Every time I see the government raise these limits, I'm kind of thinking, boy, I tell you, Social Security all of a sudden,
Well, we're less than 10 years from insolvency on
Unless
Social
what they
Security.
say,
So,
I don't know.
I'm not sure I like the word insolvency, because what it means is the trust fund runs out of money. But you're getting Social Security money comes from people who are working.
Right.
So you'll lose some of what you get if in fact Social Security goes.
you got less coming in than's going out the door. That's
Right.
you're kind of insolvent at that point. It's you.
Not the government.
No, but what's going to
Well,
happen?
they just print the money.
But that's not fair, because what's going to happen is you're going to get about 75% of what you were getting before, because people who are working are still putting money into it. It's just that there's nothing coming from that bank account, if you will, that was there. That is what is going to become insolvent. And so we're going to have to figure that out.
I'm not so sure there was ever a bank account for it.
Well, I'm using that metaphorically speaking.
But your thoughts to people of making sure that they take the most they can in their deductions is going to help them considerably.
Correct. Or sometimes there's 401k plans that have Roth options as well. So we have to look at that case by case. If there's a contribution that goes Roth or partial, maybe you do have
And Roth is a good idea, because the Roth IRAs are tax-free. Once they're after-tax money that you put in, but then they can never be taxed again.
when
Correct?
it comes out later
After
after 5
5
years, then
years.
it's tax-free. And then once again, but not all retirement plans offer that option. And then once again, you have to look at what's the impact of your salary now versus later. And sometimes people do a combination of the two.
Well, it's always good, for an individual to take full responsibility of his, financial planning and
Financial
retirement.
future.
Well, and I think the more you can put away, I'm happy
it only
that
helps,
it increases.
Well, I would want to be less dependent on the government, because, again, Social Security may cut back. The way it's structured right now, it won't be gone, but it will be cut
Right.
back.
Sure. But who's going to make that cutback?
What do you mean?
When there's not enough
Which
money
person
to go
in the
around,
office
and
is
they have
actually
to
going to
have
make
it.
that call, and how are they going to do it? That's
well,
gonna
that's my
be-
point, is
that's
that-
going to be key.
Is that they're going to have to do something,
Right.
whether it's to
Work
raise the
longer.
age,
Yeah.
which is what I would do, because when you think about it, back in 1935, I believe it was, when Social Security first started.
You wouldn't be here.
65, you're exactly right. 65 was an age that people died.
Yeah.
Yeah.
Okay, today it's what, 81, 82, whatever it is.
Yeah.
It's a lot more.
I'll say 100 years old, Jimmy Carter lived a long life.
Yes.
Right.
So, yeah.
Wow.
And actually, I believe I read this. This was a couple of years ago. That was people who are living to 100. That percentage was the highest percentage of any group. Raising it, so if there were 2, there might be 4.
Oh, okay.
But percentage-wise, that was the highest. Now I don't know if that's still the case, but the point is that we're living longer.
Yes.
Okay, so 65, most people are still playing pickleball.
Yeah.
I think you're right. When they originally came up with Social Security benefits, it was people weren't living as long as they are.
And
now.
the fight to get them to even move it up a year, from 65 to 66 or 66, 67 was amazing. Yeah. So if we really think about it, it probably should be at somewhere around 75 instead of 65, but nobody wants to do that.
They should be stepping that up.
Right.
Well, yeah, but if you've been paying in for 40 years, it's like eventually
you want to get
you'll-
some money back.
Well, I think that's part of the reason why, first of all, you should be putting more money away.
Yes.
Okay. It's also the reason why I think that what they would do is they would phase it in. So if you're 50 years old, maybe you can go to 68. If you're 45, maybe 69, 40, 70, et cetera. So you have time to prepare for that.
Or just start with the new, the very young generations and newborns. I mean, you could set that much easier, that date down the road, than someone who's already been putting it in for a couple decades. That's not going to win votes.
Well, and that's the problem.
What these politicians
Right.
want.
That is exactly the problem. It's the same reason that we have a deficit or a debt, I should say, that is $35 trillion and growing quickly. And we've talked about this ad nauseum, but again, that can't keep going on.
Yeah.
And then lastly, saving for something special, a new car, a trip, a family vacation, or just doing something on your own. That was on your list too.
Travel
So yes,
more
travel
vacations.
More
Travel
vacation.
more.
Vince, if you traveled more, you would never be here.
Travel more.
I think Vince loves to go to Mexico.
You need to do dual
Right.
citizenship.
I think that you have a hotline to Puerto Vallarta.
I keep saying we need a Southern satellite office, so that we could all rotate
Carrie won't
through.
let me have
So
it.
Southern California doesn't count?
Nope. Southern Hemisphere.
All right. Well, today's January 2nd. I will not be here. I know everyone's disappointed. I will not be here next week because I'm going to be at the Consumer Electronics Show.
Where's that?
In Las Vegas.
Oh, cool.
And I'm hopefully going to look at some of the new inventions or new gizmos, AI related and not. I'm really looking forward to this.
That's a
And-
great show.
I've
I've been to a
heard good
couple of
things.
those. They're really cool.
Right. And by the way, the 9th is next Thursday. And
The stock market is closed, but the bond, for at least for now. But the bond market is open for now until 11 our
right,
time.
and it's closed for the morning of Jimmy Carter, who passed away.
Yes.
So I'm not sure exactly if we're doing it on the 9th, but the 16th will be
Yes.
here. I will report on some of the things that I see at the show. Should be pretty interesting.
I still remember about 20 years ago, you came back from one of those when we were all working at Smith Barney, and you were so excited in talking about, the new stuff, mostly like Cisco and Qualcomm and all those companies back in the day. But I remember that.
Yeah, and it was fun. That's where I first learned about the satellite radio.
Yeah.
At the time it was
Sirius
Sirius and XM, and they were two different companies.
Yeah.
Then they merged. So anyway, that's what's going on. Thank you for listening to us this week, and we'll talk to you hopefully next week or the week after.
Great. Thank you.
Bye-bye.
Bye.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.